The market is currently closed, and the last reported closing price for Tesla stock, Nasdaq ticker TSLA, was $397.64 as of the close of the last trading session on November 13, 2025. This represents a significant intraday drop of $32.96, or 7.65% from the previous close. A sharp move that immediately demands a deeper look beyond the simple headlines. Now, the common expectation right now is that this brutal dip is a straightforward reaction to two main things: production concerns in a softening global EV landscape, particularly in China, and general market angst over high-growth stocks in a rising interest rate environment. That's the surface-level reading, and it's certainly part of the reality. However, the unexpected angle, the one you need to really grasp, is the nuance of institutional behavior within this sell-off. While the retail narrative focuses on production targets and CEO-related news, like the recent report that Tesla is finally developing support for Apple's CarPlay, an unexpected move towards standardization that conflicts with their usual walled garden approach, the true driving force of this 7.65% move is a subtle but noticeable shift in institutional conviction. We're seeing a high-volume day, indicating a major disagreement in price discovery. But if you look closer at the institutional filings from just the last couple of days, particularly the 13F forms, you'll note something critical. While behemoths like BlackRock and Vanguard are largely holding their massive positions, the aggressive selling has been concentrated in specific, highly active funds, suggesting a tactical retreat rather than a fundamental capitulation. Cathie Wood's ARK Invest, for instance, has reportedly been easing off the Tesla stock trade for 4 consecutive sessions, marking one of her most extended selling streaks in months. This isn't a broad market consensus collapse, it's a statement from a specific, growth-focused cohort repositioning for reasons tied to near-term capital preservation and opportunity cost, rather than a total loss of belief in the long-term story. This distinction is vital for anyone engaging in online investing or utilizing an intelligent portfolio strategy, whether they are on Fidelity's platform or using a self-investing tool like SoFi Invest. The general belief about Tesla stock is still rooted in its growth story. It's the king of EVs, a technology pioneer, and a future-forward integrated energy and autonomy enterprise. The expectation is that even with hiccups, the exponential growth will continue, justifying the high valuation multiples, like its substantial P/E ratio, which currently sits north of 280. But the reality that is challenging this belief comes from the grinding reality of competitive pricing pressure and tightening macroeconomic conditions. China is now a fierce battleground, with local competitors like BYD, NIO, and XPeng gaining ground, forcing Tesla to consistently lower prices. This price war directly impacts the company's industry-leading gross margins, the very thing that gives Tesla stock its premium over traditional automakers. When you see a single-day drop like this, it's the market recalibrating the tension between that long-term, futuristic expectation and the quarter-to-quarter reality of a business that, despite its cutting-edge branding, is fundamentally subject to the cyclical nature of auto manufacturing and the simple economics of supply and demand. Let's look at the mechanics of the recent stock movement. The trading volume was heavy, over 58 million shares, significantly below the 30-day average volume of 82 million, but still elevated enough to push the price through key technical support levels. The price action moved decisively below the $400 mark, which acts as a crucial psychological barrier for many traders and self-investing platforms. The intraday range saw a low near $396.42, establishing a new floor that short-term traders will be watching closely. This deep red day puts the Tesla stock firmly in the red for the year, a stark contrast to the massive gains it saw in the preceding months. What caused the initial momentum shift? Beyond the general risk-off sentiment hitting high multiple stocks, the specific news around the expanded recall of the Powerwall 2 home batteries due to fire risk impacting thousands of units in the U.S. adds another layer of operational friction. While the automotive side often dominates the headlines, the energy segment, Powerwall, Megapack, and solar, is a massive part of the long-term justification for the company's valuation as an integrated clean energy provider. Operational stumbles in that division add weight to the argument that execution risk remains high across all segments of the business. When considering a stock like Tesla, especially when engaging in online investing through platforms like Robinhood, where fractional shares make high-priced stocks accessible, you need to understand that the daily swings are amplified by its high beta, currently over 2.0. This means Tesla stock tends to be twice as volatile as the broader S&P 500. This volatility is a double-edged sword. It offers explosive upside on good news, but creates painful drops like the one we just saw on any hint of operational weakness or macroeconomic headwind. The current macroeconomic backdrop, persistent inflation, potential for rate hikes, and geopolitical instability acts like a headwind, forcing investors to scrutinize cash flows and discount future earnings more aggressively. High-growth stories suffer the most in this environment, as their value is heavily weighted to those distant, expected future profits. The underlying business model of Tesla is complex, moving far beyond just the sleek Model 3 and Model Y. It's built on three pillars: automotive, energy generation and storage, and services/others, which includes self-driving software, FSD, and insurance. The expectation is that the autonomy segment will eventually be the highest margin source of profit. The reality, however, is that regulatory hurdles and the sheer technological difficulty of achieving true, full self-driving at scale continue to push that timeline further out. Revenue from the automotive segment is still the primary driver, and while volume continues to grow, global deliveries were impressive in recent quarters, the rate of growth is slowing from its blitzing peak. And, as mentioned, the pricing aggression is eating into the profitability per vehicle. The other key factor is the energy division. Powerwall and Megapack sales are growing, positioned to capitalize on the massive shift towards decentralized power grids and home energy independence. But as the recent recall highlights, manufacturing at scale, particularly for complex battery systems, is fraught with quality control challenges and regulatory scrutiny. For investors using tools like the Schwab Intelligent Portfolios or a standard individual brokerage account to diversify, Tesla's energy story is often cited as a hedge against the pure-play auto thesis. The recall, however, puts a dent in that narrative, signaling that this segment is not immune to operational bumps. The long-term vision, the grand expectation that holds the high stock price together, is built on manufacturing efficiencies and technological superiority. Tesla is far ahead of most competitors in terms of battery technology and manufacturing process, particularly in their casting techniques and vertical integration. But competition is closing in, not just from EV rivals, but from legacy automakers who are now pouring hundreds of billions into electrification. Ford CEO Jim Farley recently made headlines stating that a shocking discovery after taking apart Tesla and Chinese EVs led him to a brutal business decision to reorganize. This indicates that while Tesla set the benchmark is now being met and studied intently. For an online investment strategy, understanding this competitive pressure is key. It means the simple Tesla is the only EV play thesis, which worked years ago, is outdated. Now it's a contest of execution, capital efficiency, and technological iteration. Shifting to institutional ownership, while BlackRock and Geed Capital Management LLC hold massive, generally passive stakes for their index tracking funds, the trading activity from hedge funds and actively managed mutual funds provides a better read on current sentiment. The fact that more institutional holders have increased positions than decreased in the last reported quarter, 2,163 institutions increased versus 1,575 decreased, provides a counter-narrative to the current sell-off. The selling we are seeing today is likely a combination of short-term profit-taking and a reaction to the technical breakdown below key moving averages, compounded by broader market negativity affecting other high-growth tech stocks, including Apple stock and Nvidia stock, which are often correlated. This is where the contrarian take comes in. The current stock drop is less about a failure of the company's long-term vision and more about a market-wide liquidity event forcing the most aggressive holders to trim positions. This is a common pattern for volatile high-multiple stocks. For those of you managing your own retirement funds through Fidelity IRAs or a self-investing account on the Robinhood app, the question isn't